Buckle up. Interest rates are falling and the recession is incoming. If we take a look right here, corporate layoffs have ramped up in recent weeks, and the interest rates, if we take a look, are falling. Look at that big decrease that we all of a sudden have seen. Now, what I'm going to show you is the correlation with the 10-year, and I'm going to get back to this. So right here, if we take a look at the 10-year, we see that the 10-year is coming down. And this is what correlates with interest rates the most, right here. Now, the direct correlation isn't a one-for-one. However, the Fed does not have to cut the Fed rate in order for interest rates and the 10-year to come down. And I'm going to touch base on this later on here in the video and explain that. But I first want to go through things that are going as interest rates are falling. We see that corporate layoffs have ramped up in recent weeks. Now, that's the 10-year, and that's right there, the interest rates coming down. Now, this right here is also something to keep an eye out on. And Jerome Powell has stated that if you have a job, you're in good standing. But it's hard to find one if you do get laid off. And if layoffs were to spike suddenly, unemployment rate could skyrocket pretty quickly as jobs are just not being created. And all of that is happening as we see that there are many more active homes for sale on the MLS. So I'm going to touch base on this. You want to make sure you're watching this video all the way until the end. I'm going to show you the correlation with interest rates. I'm going to show you the buyer's market and what you can anticipate as the year progresses with interest rates coming down, as well as the buyer's market, what you can anticipate in each given month. So we're going to touch base on all of that. And right here, if you take a look, weak U.S. retail sales, manufacturing output point to softening in the economy. So right there, retail sales and manufacturing, people are just getting tapped out. Inflation has caught up, and those inflation numbers, those readings that they give us, we all know that's not real. That's not true, saying 5%, 8%, 2%, right? It feels much more than that when you're buying anything at the grocery store, a car, a house, even when you're calling somebody to do something on your house, or you take the car to the mechanic shop. Everything has gone up way more than that. But we're seeing retail sales, manufacturing output is softening. Now that is indicating a potential recession, and that is indicating more layoffs. And we see that that is the case with corporate layoffs ramped up in the recent weeks. Now, right here, we see another thing that's going on. And pull this up. It's giving me a bunch of ads. Here we go. Home builders offer bigger incentives to lure buyers. And remember, I went over in a previous video that the builder confidence right now in May was as low as it was in November of 2023 and almost as low as December of 2022. Now remember, the market peaked in May of 2022 at $600,000. We never saw those peaks ever again. Then we saw 9 consecutive months of price drops. In January of 2023 is when we saw the last month of those price drops before the spring uptick, and then the second half of 2023 came down. Same thing in 24, uptick in the spring, down in the second half of 2024. Same thing happening here in 2025. Just follow the data, and data follows what's going to happen and what has happened. Now, home builders are offering these incentives much sooner than they have in the years past. And this is actually even sooner than they did in 2022. And we see that inventory is much, much higher than it was in 2022 or any of the previous years. And that is going to continue increasing here per the data for at least another couple of months. Now, if the builder confidence and the builder incentives are much worse or better for the buyers or worse for the builder, that is not indicating that everything is good. Now, especially with unemployment potentially going up, and that's what Jerome Powell said. He said that unemployment could skyrocket pretty quickly if layoffs were to happen because there's just not enough jobs out there. You're good if you have a job, but if you need one, it's tough out there. Now, that is all indicating that with interest rates coming down, it's not going to just open the floodgates for the buyers. Also, let's say that interest rates come down to 4.5%. There's two things that you have to pay attention to. One, and I have experience with this because I talk to a lot of people who are stuck in the situation. They want to buy a bigger house. But guess what? They can't, because they can't afford a house with the current interest rates. So if interest rates were to come down 4.5%, yes, there would be more buyers, but there would also be more sellers putting their house on the market because now they can finally go afford something else. Now, the second thing is for interest rates to come down to 4.5%, something in the economy would have to break. Layoffs would have to continue increasing, which means unemployment goes up. And if unemployment goes up, the pool of buyers shrinks because you have to have a job, and you have to have a good credit score, which I'm also going to touch base on. So we're going to go through this stuff here. Now pay attention here. Car loan defaults in the US hit all-time highs. All-time highs. Now, I don't know about all-time highs. I've been following the car market, been making videos about this for a few years. There's more Americans underwater, under cars than ever before, because during the pandemic, cars are a depreciating asset. However, they were appreciating, and you could actually drive a car for a year and sell it as much as a dealer. Just crazy times. So that is indicating that things aren't all peachy and dandy. Now I'm going to get over here to the housing market, because you're seeing this discrepancy of how much more inventory we have this year compared to last year. Now, do me a favor, smash that like button, smash that subscribe button. Nobody has your back like Dinko the Realtor. And when you do need a realtor in Utah, my contact information is down below in the description. Give me a call. I'll take care of you and make sure you get the best deal. Right here. Also, sign up for this email. I send this out at the beginning of each month, and it goes over the inventory growth of year over year for the entire market. Then I break it down to the Wasatch Front, Salt Lake County, Utah County, Davis, Weber, Tooele, then the Park City area, then the Logan area, and St. George area. So right here, you're gonna have the greater Salt Lake area. You're gonna have all of that. So sign up. The link is gonna be down below in the description. It's also gonna be in the comment. Now, continuing here with what's going on, look at this right here. Credit score impacts from past due loan payments. And right here, I'm going to summarize this because these articles reloaded for some reason. But essentially, what's going on is they're anticipating 10 million people to have their credit score impacted because of student loan payments resuming. And each month, there's more and more people that are getting hit. So far, there is almost 3 million people that have been affected with their credit score taking a hit from student loans. That means people can't buy a car, people can't buy a house, because they no longer qualify with the credit score requirements. And they're saying that 2 million, I believe it was 2 point something million people had a credit score of 620 and above, which means they can qualify for a mortgage, they can qualify for a car loan. And they've since taken hits on their credit scores. So those people with these student loan payments resuming, hitting the credit score, are now out of the housing market and out of the car market because they can't qualify. So we're seeing this happening here. Now, the one thing that they are doing, and I've been saying this for years now, is they keep kicking this can down the road. The foreclosures, and I've showed this in previous videos, that were supposed to resume. The Biden administration kicked it out further, and now the Trump administration kicked it to September 30th. So who's to know if we're ever going to see a free market here truly. But you're seeing that the state of the economy, the state of the housing market, is not really all peachy and dandy. So let's say that the interest rates come down. Look at this right here. You see that interest rates came down to 6%. You could actually, for about a week, get a 5.9% interest rate in September. That's when the Fed did their first rate cut. And anticipations were that they were going to do more and more. However, inflation kind of started coming back, put the Fed between a rock and a hard place. Now, over here, let's take a look at these under contracts. If you take a look at the under contracts, they always decrease in the second half. In 2021, they didn't. In 2021 is the top one right there, that blue, that greenish line. Now, if we take a look at the blue line, you see that this year it's also decreasing starting in the second half under contracts, pending home sales. That means less and less homes are pending, going under contract, which means inventory should continue growing if these houses that are hitting the market continue coming, which they are. We're going to have again this month in June, more houses, more homes hitting the for sale sign than we did last year. So it's all indicating that growth is probably going to continue happening, but we'll have to monitor that. Now, if we analyze this right here, we see that in September of 2024, right there, you did not see the big drop off going from September, October, and in November as you did in 2023. And also, if you take a look at 2022, it continued coming down. Well, in 2024, when the rates got cut, you see right there that the market held steady for a little bit. Rates then started going back up, and you have some buyers that, hey, they're definitely going to enter the housing market. However, you're seeing at these inventory levels. So even if these buyers come in, and let's say there's a couple of weeks, a month of higher sales happening, I mean, it's not that much. Even if you look at last year, it's not like there was that many more sales happening. So there's the line, essentially just held steady. Well, if inventory continues climbing and we're already this much higher, I mean, look how much more inventory we have for sale compared to last year. So if a couple of hundred homes go off the market each month, that's not going to just indicate a seller's market. That's not going to just save the seller's market just because an extra 300-400 homes are being sold each month with more houses hitting the market. And also, if those interest rates drop, it also will bring some sellers. So you're seeing all of this. So these interest rates dropping is not going to just automatically flip the market into the favor of sellers. Not when you have this much inventory, and not when you have layoffs, right? The softening of the economy, manufacturing output is softening, and then you have corporate layoffs that have ramped up. They have to cut costs. Stocks are taking a hit. When you do need a realtor in Utah, think with a realtor, has your back. My contact information is down below.